Welcome to TheoTrade. Don Kaufman here, November 12th, 2025. Just seconds after the cash close here on this Wednesday afternoon. The S&P's finishing the day massively unchanged. You know it, you love it, it is massively unchanged. Look, the markets, they're just kind of ebbing and flowing right now on the upper edge of the expected move in the SPX. And again, I cover this on the weekend updates. I always cover this on the Wednesday updates that I do, and continue to see markets not just hit the expected move, but literally like adhere to the expected moves. You know, ironically, we were talking about the exact opposite in last week's trade. In fact, take a quick glance at the SPX when I'm talking about kind of ebbing and flowing on the expected move. We literally rallied into the expected move yesterday, okay, and we haven't moved off of it. I mean, it's just absolutely spot on. And what level is that? And again, when I'm talking about the expected move, and I'll cover this in more detail, but you're looking at 68, basically 52. And again, 68.52, and I'm actually going to just denote that 68.52. What is so critical about that particular level, and what's so critical about expected move? And for those of you that are kind of in the know, this is how the option marketplace depicts risk, okay, on a week-to-week basis. So if you will, it's like averaging all the option pricing together. It actually uses implied volatility, and it gives you a pretty good feel of what market maker, or what we term dealer gamma risk, happens to be. And it has literally been spot on. You can see this week we're like literally adhering to the upper edge of the expected move, but in kind of contrast for just a moment, let's actually show you last week. Let's drop back 5-day, 1 minute, and just show you like last week, okay? We had actually rallied back. Last week we were at the lower edge of the expected move here. We hit it on Thursday, and then Friday it was like all hell breaks loose, and we actually rallied back within a few points. You have to understand, okay, the efficiency of this marketplace. And this is a $6,800 product, okay, that is missing a level that I drew on a screen, okay, by a few pennies. It's shockingly efficient to be able to use that expected move. And what the remainder of this week comes down to, people want to talk about your MACD and your Fibonacci. Look, I'm not big into the Fibonacci's, all right? Did the magical 618 beast tell you to say that? I'm just not that big into it. And they want to talk about that, but what the expected move is, okay, it's not, you can call it a technical indicator, but it's a skin in the game. It's billions of dollars at risk. And what the remainder of this entire trading week kind of comes down to is whether we actually crack inside of it, in which case you'll see some fairly precipitous sell side activity, okay? Or, and this is what's important, or do we crack above it? And when you have this kind of expected move, you get about 15 points of freedom, okay, higher, and 15 points of freedom kind of lower off of it before you quote unquote officially break off the upper and or lower edge of an expected move. So you can see that almost entire trading session today, we traded in, if you will, that kind of 15-point window. And where do we end up the day? Literally back on the line. So it's kind of a big, nothing burger of a trading session. But here's kind of the kicker with this, okay? Is there upside potential to the marketplace? Absolutely, okay? But the upside potential with expected move over here is somewhat limited. Like even if we break outside the expected move, let's go back to a daily chart, kind of zoom in and kind of game plan this. Even if we break kind of outside an expected move, okay, you're already stretched up here. This is like looking at a distribution curve, and we're basically at, okay, one standard deviation. Okay, let's get crazy. Can we break outside that? Absolutely, you can break outside that. Barring any unforeseen like news though, okay, it's going to be a limited breach, if you will, to the upside of expected move. On the flip side though, and this is where I often talk about risk reward. So let's get crazy. Let's go all the way and say like, yeah, the market right now, it could get to 6,900. Okay, and that'd be like again, you're 50 points outside of expected move. And the expected move this week is about 123 bucks. So you're 123 plus an extra 50. It's a big move. That's a really big move, and it'd be really stretched to get to 6,900, for instance, by Friday. But on the flip side of that, and again, I want you to think about risk reward. Everybody thinks about direction of the marketplace, cares about direction. You got to start talking about risk reward, because you want to be able to make some money in here. Okay. And this is why people constantly cut profits short and let the losers always run. Look, okay, right now you got about 50 bucks to the upside. To the downside, though, if you saw some sell side activity and we broke off this upper edge of the expected move, there's some precipitous sell side activity. You could easily revert back down 70, 100 points and end up very close to unchanged on the week. And that's the nature of the beast. And the beast happens to be its dealer gamma. And that's what a lot of people, they just don't get. That's why I like to focus more on like risk reward. It's not about being bared up. Look, right now, okay, there's some pretty good downside potential. And if you will, you always go with probabilities, right? So what's the probability of being inside the expected move? Well, there's about a 68% chance in any given week that we're going to fall inside the expected move. Breaching the expected move, it happens. Okay, it definitely happens. You can see some highlighted, areas. That's a pretty big breach to the upside of the expected move. Here's a huge breach to the upside of the expected move, a breach to the downside. Look, it happens. Okay, but you'll notice, okay, that upside potential is, again, it's very, very limited. In fact, the largest breach of expected move is over here, and you're going all the way back to the time frame of May. Very likely news driven. In this case, this one happened to be news driven. The other breaches of expected move, look how minimal some of these happen to be. So I wanted to spend tonight's video and just, tell you, like, look, okay, in the market today, not a whole hell of a lot. Don't read too deeply into this. Okay, it was a slop fest. You start looking at like the advanced decline line. The advanced decline line's positive. Okay, nobody cares though, because Meta's down 18 bucks. Speaking of Meta on a year-to-date basis sucks. It's massively unchanged. Okay, now I'm going to switch gears for a second over here, because we're talking about risk reward. Now we're talking about, some of the tech stocks. Yeah, look, the advanced decline line doesn't even matter anymore, because, it's very strong, very positive advanced decline line. There was a rotation into financials today, but you start looking at things like Meta, okay, it's unchanged on the year. You start looking at Tesla. Tesla's only up 13% on the year. You're like, that's a lot, really? Because it's underperforming the S&Ps by about almost 4%, okay? What else you got? What else you got there, big guy? Okay, you go like, oh, let's go look at Apple. Yeah, Apple's up 12%, underperforming the S&Ps, okay? Amazon. Oh, no, I'm sorry. Amazon is only up 10% on a year-to-date basis. Microsoft, okay? All right, you got me on Microsoft. And here's the big one, okay? Google, Microsoft, Google, okay, and NVIDIA are kind of the outperformers. That's your marketplace in the entire year. Like, that's your marketplace. You're going to point, of course, to financials, 11% on a year-to-date basis, okay? It's getting wild out there. When some people start talking about like AI bubble, okay, maybe it's already starting to come apart in a big way. We might still be trading all-time highs because we're seeing rotations, but maybe it's already starting to come apart. When you start to see some of the key players, okay, there's no Magnificent Seven. That crap is gone. How magnificent is a 13%, year-to-date gain on a guy that just got $1 trillion, salary package, possibly, okay? NVIDIA, all right, they're still getting it done, but things got a little scary. Earnings are coming out over here. Meta, though, gone, okay? It's massively unchanged again on the year. So be mindful of this. All right, so I talked a little bit about risk reward in the SPX, talked about what I think is some the fall, if you will, of some of the players in the game over here. Give you one other one that's kind of got me actually looking right now. Somebody sees some risk because the VVIX is actually back up. This is the volatility of the VIX. All of a sudden, like, markets, they're rallying. There's no real contract size trading. The volume is very light. The liquidity is really, really light. But again, today, unusual. You have the marketplace basically up. Volatility, though, okay, was bid. And the volatility I'm looking at is the VIX of the VIX. That means that trade is going in, stepping in, and buying volatility once again in the VVIX. So there's some nerves right now to the marketplace, and of course, most people are looking already for the Santa Claus rally. Okay, don't put away your Santa hat. It's not even Thanksgiving yet. Put away the Santa hat. Okay, there's still a lot of trade left. And again, be thinking about to the remainder of this week exactly the risk reward that I talked about. Seriously. Okay, look, there's news that's going to come out today, news that's going to come out tomorrow, but constantly think about risk reward. Upside potential, okay, for the remainder of this week is limited. Downside risk, though, okay, is significant. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.